Location, location, location. We've heard this a million times when it comes to real estate investing. All investors know that you need to choose the right locations for your investments. But if everybody knows it, then why do so many investors make the mistake of investing in bad areas, right? How do you know what's a great location for somebody else, but might be a bad area for you? Or vice versa, a good area for you, but might be bad for another investor? How do you know what doesn't look so good right now, but is going to be a great area to be in down the line? Or vice versa, looks good right now, but it's not going to be so good down the line, right? These are some of the questions that mix people up and lead to investors making bad decision calls. So stay tuned, because in this video, Hannah and I are going to talk about the exact frameworks that savvy investors use to make sure that we're investing our money in the right areas at all times. This is Tyrone. If we haven't met before, I have managed hundreds of properties over the past decade, from the hood to the suburbs and everywhere in between. And I'll tell you, I've seen this play out time and time again across many different portfolios. So stay tuned. Let's get into it. Hey guys, welcome back. In this video, we're going to be zeroing in and identifying the perfect property locations for our investments. Now that we've boiled down the different property classes and understood the nuances of investing in these areas, we're going to add on top of that and really outline where you should focus.
Yeah. So first thing to consider is what areas are most ripe for growth. So we kind of mentioned this before in our last video, but really looking at areas where, you're watching for those trends. So what industries or businesses are coming to the area or supporting the area? Because it can be already established businesses and industries, but you want to make sure that those industries are stable or that they are growing as well.
Yeah. And you can look at it simply as following the money, right? Following the trend, and the perfect trend to follow in real estate is the money. Where's the money going? If businesses are coming in, either new developments or existing companies that are adding locations there, you have different, political factors that are driving investment in that area. Those are trends. And you're looking at basically being able to clearly identify why this is becoming a more desirable place to live, right? We want hard evidence, and we want to be able to document things that are in progress, not rumors or not news stories or anything to that degree. So follow the money.
Yeah. And I'm just clarifying something Tyrone just said when he's talking about political things, but you're looking at for like, where are there initiatives or grants, or where is governmental money? I don't know a better way to say it, but governmental money going, like what are they investing in and where are they investing it?
Yeah, I say an example of that could be like tax incentives, tax abatements that the local government has given to property developers who come in and develop properties. So if you start to stack some of these things up, it's a decent area, it's close to good areas, that it's not, on an island by itself in the middle of nowhere. And then you see that the government is offering very strong tax incentives to companies that come and develop there. And then those developments are happening. Okay, it's working. The money's coming in.
Also, in terms of growth, you want to look at like who is currently living in the area and who's moving to the area. So looking at the younger generation or young families or young professionals, where are they gravitating towards? And those tend to be the areas that are going to see the fastest, most stable growth.
Yeah. And one thing to watch out for when we're watching these areas in terms of the migration patterns, people coming to live in, you want to make sure that you're not looking at what appears to be a strong area, but people are actually moving out of it. That's an easy trap to fall into.
Can you explain a little bit more?
So if over time you're seeing that the population is actually decreasing for whatever reason, there's typically underlying factors that may be causing people to basically move out of the area. Maybe a high profile company or industry was relocated, maybe a plant shut down, maybe a hospital shut down, whatever it might be. There was some economic force that was driving the base in that area, and that may have went away or maybe going away. And then you could look at the area, and on the surface, it could look like a very strong area. And then you invest there, and then later on, you realize that it's actually on the decline. So watching those trends and not only identifying what happened in the past, what the historical numbers have been, because it can look like this and it can level off and go the other way, but also know that economically it's strong and it's continuing to improve.
Another thing to consider when evaluating location is the power of proximity. And in this, we mean as investors, especially before you become advanced investors, you want to be looking at areas that you yourself are like familiar with and close, like I'd say intimately familiar with, like truly familiar with, like they are around you, they are near you, they are where you live or nearby where you live. or where you frequent often. You might have a vacation home in an area that you're very familiar with as well, and that you can also get to easily.
Yeah, there's a number of reasons why that is going to be the safest place to establish the base for your portfolio. But one of them being that you basically have not only better knowledge of the area, but you will tend to have better access to resources in the area. If you live there or have lived there, you know people in the area, you have reference points to understand what's going on in the area. You are able to reach out and touch people, right, in a way that you cannot if you have no familiarity or no experience looking in an area. You're not an outsider, basically. You don't want to start out your investing, like basically start your portfolio in a place where you're an outsider and don't have any base there. Regardless of whether you're self-managing or you're third-party managing, you don't want to start out that way.
And I'm gonna even add on to that just to make it maybe a little more clear. Just in terms of like one, even dealing with owners and trying to get the deals, it gives you an advantage to be familiar with the area and from the area and know it. Again, not being an outsider is going to give you that advantage. Two is having your ear to the ground, essentially. Like you hear things, you know things before it might be mass publicized or before it's general knowledge, because it's just your area. And three, it's like those contacts, meaning like contractors or service people or different people in the industry or different reputable companies that can help you with those properties.
Yeah.
We also really recommend going deep versus wide. And what we mean by this is really targeting very specific areas rather than being spread thin.
Yeah. In our area of the country, we're in a very unique place. Not very unique from this standpoint, but within a 30 to 40-minute drive, you can be in 10 plus towns. So if you think about different cities, municipalities, townships,
States where, we're within close proximity to different
within a
states.
30, 40-minute drive, we can be from we're in Pennsylvania and Westchester, we can be in Delaware and New Jersey, Maryland. If we go north, probably an hour and 15, 20 minutes, you can get to New York. So you think about that from that standpoint, it would be very easy to kind of cast a net where you might say, all right, I want to invest within a 45-minute drive of where I am. That could be a very wide base in terms of areas when you have so many areas condensed into in a short drive. So it's best to identify specific towns, specific municipalities, get to know them very, very well, because that's also going to be your advantage.
Or I'd even say neighborhoods if you're looking at cities, like even neighborhoods within the city.
Yeah, neighborhoods within this, but especially the larger cities, because living out in suburbs where we are, going to a different town, that could also be you have a similar effect to being in Philadelphia, where you drive 10 minutes away, you're in a completely different neighborhood. It's like almost night and day in some areas. So getting very granular to the point where you know your areas very, very well. It not only does that protect your downside because you are so intimately knowledgeable of those areas, you know what's going on, you understand the tenant base very well, you understand the industry, all these different things about the area, but that also becomes your advantage when it goes to actually finding and analyzing and securing deals in those areas. You get to a point where someone who has that level, you get to a point where you have a granular sort of understanding of properties in that area, then you get to knowing exactly how much a property should be selling for. You can look at it and you can look at the condition, you can look at whether or not it's rented, how much it's rented for. And off the top of your head, you can come up with what that property should go for, what you're willing to pay for that property versus someone else who has to do that full evaluation every time they look at something because they're spread out over all these different areas.
It becomes a little more intuitive.
Yeah.
Additionally, it also is just going to save you time because, again, you're going to have your service providers locked down in those areas. And then if you yourself are having to drive to manage any aspect of the property, you're not driving all over the place. You're in one central location.
Yeah. So we talked about those efficiencies of scale when you're dealing with multi-unit properties, multi-families, even if you have single families, but they're all condensed to the same areas, the same towns, same neighborhoods, then you can understand how you can achieve scale, even if it's not in the same building, if they're close by.
So, yeah, those two kind of are very closely related that we just wanted to. And it doesn't mean that you might not pick multiple towns or multiple neighborhoods. You can have a diversified portfolio, but you still want to just have them very specified instead of a wide range.
Yeah. Understand exactly where you're investing within that range if you do it by range, but those towns specifically. One thing that I will add, and one principle that is good to abide by when you're thinking about different towns, different areas, different locations, essentially, is to live where you love and invest where your money grows. What that means is we, as people in general, you're going to have the areas that you really want to live in, but you may really want to live in a class A area where you really cannot afford to buy much property yet, and you're not going to get much cash flow. So it does not match with your investment goals. If you're looking for aggressive growth, you're not going to find it where you want to live. So separate the areas that you love from where you want to be perspective from where your money goes. Your money should be going and following the trends that are pointing to aggressive growth. I mention that because that is one that often trips up newer investors. And we see that a lot. Folks really, well, I really want to own property here. I want to own property there. Well, your money's going to grow quicker in this class C area that's a half hour from here versus you investing it right around your house, because you're going to buy a lot less property and have less cash flow and lower returns, and it doesn't make a lot of sense. So,
And I'd say that's two things. Like sometimes that's just emotion. People just emotionally want to own where they love, or but it also is sometimes where they're more comfortable. So they're like, well, this is where I live. This is what I know. So you might have to become a little more intimate with some of the other areas. So, this requires doing some research and then like getting in those areas. And as you're investing in those areas, you're becoming more intimate with them and understanding them better and better and better. So it just becomes all more intuitive and natural.
yeah. And a good way to start to get your arms around areas like that would be to network and get involved in those communities, meet, network with investors in those areas, people who live there, people who invest there, people who own the businesses there. You can start to become very knowledgeable of the community, even though you don't live there, especially if it's close to where you live relatively.
So, lastly, we're going to wrap up this video by talking about making sure that you're avoiding those booby traps. So, making sure that you're not getting sucked in by things that look like really good deals. We can't figure out why they're so great. Usually, there's a reason.
It's a very slippery slope. And it's easy to get caught in when you're not sharp on your game. You're not sticking very closely to your criteria and keeping these things in mind. It's easy to buy a property that looks like a very good deal. It's priced just right. You're thinking, this is priced great.
And the financials might, if it's supported, like you might just evaluate it simply on the financials, and it might even support the deal.
Yeah.
Flies.
But it is, say, for instance, right next to a freeway. There are things that deep value a property under the surface, I'll say. You can have two properties that are listed for the same amount and they be a couple blocks from each other. And one is close to a set of railroad tracks, has railroad tracks running right behind the backyard, right? Something like that is going to basically devalue a property or decrease the attractiveness of that property. So you always want to be thinking about it in terms of resale. And when you're thinking about resale and demand for a new buyer coming in to buy that property, you have to envision yourself moving into that property. That's one easy way to boil it down. Would I want to live here with my family? If not, why? Well, because this is an extremely busy road. The streets are not well marked. There's no stop sign. There's no stoplight here. I have kids. Things like that are going to be things that you want to be aware of. Railroads, power plants, school district lines. One experience that we had a very close call. It wasn't very close, but it was pretty close. We were working on a deal about 2 years ago, and we could not determine why this deal was so good. And we kept getting the sense that this is too good to be true. Something is going on here. It was a single family property. We were going to buy it. We're going to renovate it, rehab it, do our whole strategy, cash out, refinance it, and let the tenant live in there and let the cash flow ride. And the numbers were great. We looked at the school district of the area. We looked at the comps, everything dialed in, good tenant base, good solid C-class property, and not far from a class B area. It was one time we were basically looking at the map, probably the 30th or 40th time, because it was not sitting right. Like, this guy was very keen to sell it to us, and we are like, where's the competition for this deal? We realized that this property was the last property that basically was in a desirable school district. And then right on the other side of that property line, on the same block, it got into another school district, which was very undesirable. But the block itself, you couldn't tell the difference, right? It was, and for families in this particular area to go into the other school district, that's a very clearly defining line.
So you were saying the property was on that line, like it would have been in the undesirable.
Undesirable schools, yes. We realized all the properties on the block coming all the way down, and then across the street, the good school district extended further down on the other side of the street. On our side of the street, it stopped right before it got to our property. And we thought, holy heck, if we had bought that on the surface looking very good. And of course, the agent, the seller, they're not going to tell us these things. They were not disclosing this stuff to us.
And they don't have to.
Yeah.
Like school districts.
Yeah, they don't have to. But and if we bought that property, we got ourselves into a situation where it would have been a much lower value than we thought it was. And it would have been harder to resell that property.
And even rented. And we're done.
And rented. Yeah, same thing as a single family, 4-bed, 2-bath, probably have a family in there, probably care about the school district given the area, and that would have been a problem.
Yeah.
So those booby traps, that one good way to sum it up is if it seems too good to be true, for some reason it typically is. Property condition also brings in some of those other things, major things like electrical, structural. Okay, we'll get into that more later when we talk about renovating and rehabbing properties.
And how to do due diligence.
Yeah, on the surface, a lot of times things look great, and for some reason there's something there. But we're always looking for those reasons that would kill a deal and trying to uncover as many of those as we can.
Yeah. And actually, a rule of thumb, again, I'm sure we're going to restate it later on, and it goes to the whole due diligence process. But really, that's what you should be aiming to do is always be looking to kill a deal. Try to see why it wouldn't work. You're not looking to try to make the case that it should work. You're looking to make the case that it doesn't work. And that just protects you. So
Exactly. One bad deal can erase profits, momentum, and all the upside from a number of good deals. So we want to remain diligent. And no matter how many properties we buy or no matter how many properties you buy, you should always be looking at it like it's your first deal. Like you cannot afford to lose money on this because it can quickly turn the other way and then turn to an ugly situation. So that wraps up this video. And next we are going to wrap up this module and bring it all together and really summarize where you should be focused, what types of properties you should be looking at, and where.
see you soon.